Hello and welcome to this special edition of Let's Talk Tax. We're here today to spend some time talking about what might be announced in the budget on the 26th of November. There's certainly been a lot of speculation and a lot of discussions in the press about what we can expect to see. So I'm Chloe Ellis, I'm one of the tax partners focusing on corporate tax here at Forvis Mazars, and I'm delighted to be joined by Paul, who specialises on the private client tax side of things, Raj on employment taxes, and Nick on financial planning. It's probably a good place to start with you, Paul, because there's certainly been a lot of speculation on the private client side of things and what individuals can expect to see. So I'll hand over to you.
Thank you. We certainly have had a lot of announcements and a lot of speculation about what might be covered. If we break it down into sort of 4 or 5 main areas and start with wealth tax. So wealth tax is something we don't have in its direct form at the moment, and actually will be really difficult to bring in. There'll be a significant tax legislative rewrites to bring it in. But we do have elements of wealth tax that could be extended more easily. One that there's a lot of speculation about is charging on valuable residential property. There is a regime in place already. There is an annual tax on envelope dwellings system, where expensive, high-value real estate that is used for residential purposes that's held in a structure is already charged an annual tax. And that could easily be extended to any residential property held by an individual over a certain threshold. Equally, there is some discussion about a percentage levy as a flat rate as soon as you reach a value of a property over a certain level. When we look at wealth tax, we actually really are talking about capital taxes. So capital gains tax is something that has been in the press, was in the press before last year's budget. And capital gains tax could change in a number of ways beyond the rate itself. So we currently have a relief for primary residences, which again could be restricted based on a value of the residence. There is a CGT uplift when assets pass on somebody's death. The base cost of those for the capital gains tax calculation is uplifted to the value of the date of death. And we could see that restricted, particularly where there is an inheritance tax relief. So there's no estate tax in the form of inheritance tax payable then. We could see some other tightening up of some reliefs for capital gains tax. We could see another change in the rates, but perhaps that's less likely. Income tax is obviously a big source of funds for the Treasury. Income tax could increase and would fill the mystery black hole, but is unlikely. But we have seen rates frozen, limits frozen for a number of years, and that could continue for a bit longer, essentially collecting more tax through a stealth tax. Then inheritance tax. Inheritance tax has changed in last year's budget. Inheritance tax is quite possibly going to be up for further reform. One thing that didn't change last year was the rules around giving during your lifetime. So a lot of people are aware of the 7-year rule, and one of the things that's speculated is that the 7 years might become 10 years or even longer. There is an unlimited amount of lifetime giving that 7-year rule applies to, and we could see a lifetime cap on how much you could give away. We then got, for inheritance tax purposes, the big change that was announced last year, which was the changes to restrict relief for businesses, trading businesses, and for agricultural property. We may see further adjustments to that. But either way, those announcements that were made last year that are due to come in April 2026, they will inevitably be having a big impact on people right now. And people really need to think about, as they run up to April next year, what to do. And the other big announcement that we had in last year's budget for individuals were the millions of people with private pensions and the impact of IHT on those. Nick, do you want to pick that up?
Yeah, thanks, Paul. As Paul said, we now know that from April 2027, pensions are going to fall into people's estate for the purposes of calculating their IHT liability. And essentially that exposes people to potentially double or triple taxation on pension funds left on death. And what that's meant is, even before these rules come into play in about 18 months' time, a lot of our clients are already taking significant steps to look to wind down those pension funds in life and ultimately aim to die without any significant pension funds left. So that is meaning people take a very different approach to their sort of personal income strategies and their gifting strategies than they were this time last year. So with that sort of backdrop and these changes to pensions and IHT being sort of partway through now, we're hopeful that pensions might be left alone in this budget. But of course, the rumour mills would suggest otherwise, and our clients are very much sort of worried about sort of three main things, I think. One being the removal or the reduction of the lump sum allowance. And since its detachment from the lifetime allowance a couple of years ago, that does seem ripe for the picking potentially. Albeit you do have to think about the impacts that it might have on people with defined benefit lump sums like doctors and civil servants, which I think is a reason why we won't see a complete removal of the lump sum. Again, there's rumours around tax relief changes and will the government look to take away higher and additional rate tax relief on pension contributions? This is rumoured sort of most years, and I think is actually very difficult to implement. So we're fairly relaxed on that point. And then the last one is the triple opt guarantee, which is much talked about and has seemed particularly generous in the last few years with significant rises in inflation. So we do feel that that's potentially at risk and will certainly be under review by the government. So whilst we'd like some stability with pensions, we do think there are areas where it could well come under focus in the next month or so. I guess outside of that, in this sort of world of personal finance, you mentioned IHT pool, and we're seeing lots of clients taking those changes to their planning strategy and now looking to gift more away earlier on in life. So there's some sort of conversations around, will gifting rules be changed? Will there become limits on how much you can gift and on the gifts out of surplus income exemption, which is becoming more prevalent? And then one that's quite niche, but is coming up with some of our clients is IHT efficient investments. They tend to take two separate forms. One is AIM-based, so investing in stocks that are listed on the AIM market. And then the other is business relief specific schemes. At the moment, there seems to be a bit of a gap in the legislation where one will only get 50% IHT relief from next year, while the other will remain fully exempt up to the £1 million limit. And we just would like some clarification on that point, really.
Okay, thank you both for that. There's certainly a lot on the individual side of things, but maybe we pick up now for a few minutes on the kind of what we expect to see on the business tax side of things. So just to pick up on that, on the corporation tax side of things, we're not anticipating any changes around the tax rate, and we expect that to stay at 25%. I think areas where we would expect or there could well be changes would be around some of the incentives. So things such as the R&D tax relief is still a very valuable relief, and we may well see implementation of ways to make that more straightforward, quicker processing of claims, etc. So it's relevant to those that can maximise that relief. I think there could be other incentives to widen, say, capital allowances regime, which could really incentivise to help that investment and the growth of the economy. I think we'll continue to expect to see areas where there'll be changes in legislation and things brought in line with OECD guidelines. So things such as the transfer pricing, there's been draft legislation being discussed for medium-sized entities, and we would expect some clarity around that. And that really, again, is in line with those OECD requirements. I think other areas on that incentivisation side of things would be on things such as approved share schemes. So there's been speculation and talk around widening the eligibility of things such as EMI tax schemes, which is a very generous tax relief for share schemes, but it's only available to certain companies. So it wouldn't be surprising to see that being increased, the eligibility, so that larger companies could take advantage of things such as EMI. But that's probably a good time to pass over to you, Raj, to pick up on some other areas where we'd expect to see on the employment taxes side changes.
Yeah, thanks, Chloe. So, yeah, I think when we look at the employment tax side, there's a number of areas where we'd like to see or we'd hope to see some flexibility and agility, but I worry perhaps we won't. So, for example, if we look at off payroll workers, IR35, you'd hope for increased levels of agility and flexibility to allow employers and end users to use these off payroll workers more flexibly and be able to meet their demands on an ad hoc basis. Unfortunately, we think what's likely to happen if what's been going on over the last few years, we'll see further enhancements from HMRC's focus on this area. So perhaps stricter regulations, stricter enforcement. So perhaps we won't get that flexibility that we'd hope for. Similarly, if we look at it from a employee benefits perspective, when we look at things that employers are particularly keen on these days, as are their employees, around lifestyle benefits and well-being benefits, we'd hope for some degree of, again, tax and NIC efficiency around some of those to encourage employers to provide those. But that, again, we look at that in the context of, for example, there are extensive rumors out there that salary sacrifice for pensions will come to an end, potentially from the NIC side. Will it be a full ending of the exemption, or will it be a partial ending of the exemption? We just don't know. There's many questions in this space. So again, things we'd like to see, but potentially what we will see, bearing in mind we know the challenges the Chancellor has right now. And then when we look at it from a sort of a non-tax perspective, when we look at immigration, for example, we know there continues to be huge skill shortages in the UK, skilled workers, etc. We'd hope for, again, and I keep using the word hope, but we'd hope for agility, flexibility, and changes in the immigration legislation to allow for employers to be bringing in skilled workers into the UK. However, when we look at that within the broader political context and what's going on right now, again, I suspect we'll get stricter rules, more restrictions, and perhaps some angles where employers won't be particularly appreciative of those changes. But again, like I say, there's a lot to unpick here and we don't know quite what's going to happen. But, again, there'll be many questions at the end of all of this, but we wait to see what happens in broadly a month's time.
Thank you. And that kind of feeds into a good way to end in a summary. There's a lot to unpick here and we don't know exactly how it will turn out. But we will certainly be keeping abreast over the next month and sitting down and listening carefully on the 26th of November. So thank you for joining today. Feel free to reach out to your contacts in the meantime with any questions and we'll provide an update after the budget.